Yeah, let me talk about the market. I've been in this game. First of all, thank you all for being here. I've been in this game a long time. And the most important aspect of this game is rarely ever talked about. You know, we sit here and we talk about technical analysis day after day, minute after minute. Some of you playing 1-minute charts, 5-minute charts, 10-minute charts, 15-minute charts. God knows I don't know how you do it. But, you know, and the stuff I'm going to teach you today applies to all charts, all time frames. It doesn't matter. So it's applicable to anything and everything you want to use. But there's an aspect of the game that is rarely ever spoken about, and I like to take time to talk about it because it is the single most important aspect of the game. And because so few people talk about it, I think it needs to be discussed in detail. And not only for understanding it for what it is, just on the surface of it, and I'll get into it in a minute, but how it plays out long term as well. It not only has ramifications for the short term, but has ramifications for the middle term and the long term as well. And what I'm talking about is emotion. It's very easy to sit here and you're seeing all these different people today. Everybody's registered for different people, and they're all talking about the stock market, which is great. It's what everyone should be doing. They're teaching you technical stuff, maybe some fundamental stuff. I'm not sure what other people have been teaching today, but I would gather that the crux of most of what's going on today is a technical perspective. And I'm going to show you technical stuff. But talking about the emotional aspect of the game is far more important because you can't do your technical work if you're emotionally involved. If your emotional perspective is skewed, and if you're not playing the game properly, you can't play it well, because what you're going to do, and you'll all shake your head yes when I'm done, is you're all going to say, yes, I've sold and then the market's gone up, I've shorted and then the market's gone up, or I bought and then the market's gone down, or I bought calls and then the market's gone down. By the way, I don't think options is very wise for most of you out there. It's too rough. I think you should be buying or selling stock, shorting stock, but you should not do options too often because it is a game of destruction for your portfolio for the most part. It's great to get the leverage, but see, then options become too much of an emotional game. When you're not identifying a market correctly, if you cannot understand where the market is in a given moment in time, you cannot be a successful trader because emotion is going to get in the way. You need to understand from a technical perspective where support and resistance really is. And more important than that, what kind of market are we in? Are we in the bull market? Are we in a bear market? And once you've identified which market you're in, then you have to be able to identify in what area of that market are we in? What phase of the bull market are we in? What phase of the bear market are we in? And where are the critical levels that I need to know? And I can tell you right now, folks, it's 2134 in the S&P and 2040. Those are the only two numbers that matter. We've had a double test of 2040 bottoms. We've had a triple test of 2134 tops, and anything in between right now is noise. Are we still in a bull market? Yes. You're in a bull market until 2040 goes away with force on the downside on a closing basis. No matter how bad things look, 2040 is still your key. And if you look at the market today, take a look at two very critical parts of the market that have been in bear markets. Semiconductors, massive positive divergence on the daily chart. Transports, a very vicious bear market that had huge gap ups. They closed on their highs, massive candles on stocks like UPS. It's very hard to take a stock market. If you push the emotion aside, if you want to be bearish, I understand you're wanting to be bearish, but that's where the emotional process comes in. You have to be able to look at what are the sectors that hold up the market. Well, why the semiconductors were falling, and while other sectors were falling, like the transports, the financial stocks were holding the market up along with some other areas. Now the financials are pulling back a little bit, but as the market's ready to lose 2040, all of a sudden, here comes the big candles on the transports and the semis. So the point of it is you have to look at the market very, very quietly in your mind. You look at it without emotion. You can't have a process in your mind that says, I believe the market is going to do this. That doesn't work, folks. There are no I believes. Your I believes are useless and meaningless and have no say in anything positive. You can't play on belief or because you want something. You have to play on what you see. While the move off the 2130 top has been pretty nasty on the way down, have we broken 2040? No. Do we have bottoming candles on the semiconductors and the transports today? Quite possibly, yes. And if those two sectors decide they want to have a move to the upside, no amount of emotion that says, I think this market is going to get killed is going to stop the market from not getting killed. Again, the emotional process is very powerful in this game. And if you let it affect you, you're not going to see things clearly. So the number one most important thing you all must do is remove your belief systems from the market. You must be of a blank mind at all times and let the charts, and if you're a fundamentalist, that's great. Let the fundamentals and the charts together guide you. There's nothing wrong with being everything. I will tell you, folks, that charting isn't the only way, that being fundamentally sound isn't necessarily the only way. You can combine many different aspects of the market. Use them together. Look, all of you have chosen many different people through your trading experience to guide you. You have not only one service, most of you have multiple services. I can tell you the people in my service admit to having multiple services. You're looking for the very best you can get out of everyone. All of it is meaningless if you can't keep your emotions in check. This is why I spend time in the beginning of every little webinar I do talking about it. Because if you're affected by your own thoughts instead of by what you see, you're in trouble. Yes, the transports and semis are terrible, and everyone will tell you they're terrible. But if you look at the positive divergence on the semiconductors, on the daily chart, and you look at the candlesticks on the IYT especially, and the semis today, you're going to have a very difficult time if you're being objective about it, saying, you know what? Things really look terrible. They don't look great. I'm not saying things look good. The monthly charts are terrible. Breadth has been terrible. Even on the upside, fewer and fewer stocks are carrying the day to the upside. But you know what? A lot of these stocks are in bear markets, and they've been in protracted bear markets, and now maybe they'll start to come out of it. You must, with a capital M, you must take the emotion out of the game. If you have any prayer of having success, you must take the emotional process out of the game. It really is as simple as that. I'm not trying to poo-poo anything about anything. I'm only trying to make it very clear to all of you that if you can't take the emotion out of the game, you have absolutely no chance of success. Now, there are many, many different ways to succeed in the stock market. Many different ways. There's long-term holding for those who can identify a market and decide they want to do that. Then there's trading. There's just trading, and there's very short-term trading. There's minute charts, 5 and 10 minutes. And then there's more of the swing trade variety, those who play, which I love to do. You're playing the daily charts, where you could go out weeks at a time. There's no right and there's no wrong. There's what you do. And that's completely in your court. I don't suggest 1 and 5 minute chart playing because you can lose your mind. And I get that. But if that's what you need to do, fine. What I'm about to show you is literally applicable to every single time frame that you can think of, from monthlies down to minute charts. From monthlies to minutes. It doesn't matter. So anything I show you here is good. One of my very, very favorite ways to play long term and to play short term is through divergences. MACD, which you see here, MACD, moving averages that can converge and diverge. What we're focused on is the 12. That's your positive line. That's your thick black line. Identifying divergences is key. Why? Here comes that word again, emotion. When you're in a market that's moving in one direction, hard, down or up, and yes, there are positive divergences and there are negative divergences. When you are dealing with markets that move down hard for a protracted period of time or up hard, the hardest thing emotionally to do when things look terrible. The other thing that's really hard to do is to sell when things look great. Again, taking the emotion out of the game as much as humanly possible. How do you identify a positive divergence, and what does it mean? This again, I remind all of you out there who are the very simple day traders, okay? This works for 1-minute charts. No problem. It works for monthly charts. No problem. So you could use this for long term. Some of the very, very lucky calls and fortunate calls I've made over my career, which gave me somewhat of a name, was identifying long-term bear market bottoms and long-term bull market tops. When you are looking at any stock or any index, some of you often ask me, does this apply to every index, every stock? Yes, this applies to every index and every stock. It doesn't matter. It's all there for you, okay? So remember that. Anything is fine. So, in a market that's in a downtrend, how do you identify a positive divergence? Well, you're looking at the MACD. And what you're doing in a positive divergence is identifying the most recent lows to themselves in price. It can be an equal low, or in most cases, a lower low. It can be an equal low or a lower low. So the big question becomes identifying it, and then at what moment do I buy for the short and or long term, depending on the time frame chart that you're using. And I will tell you how you do that. First, let's see the divergence. Here's a low. The MACD keeps making new lows along the way. You come up and you make an equal or lower low, here a lower low, and notice how much further up the black positive line is. So the first thing you do is identify the potential divergence. Doesn't mean that if this stock kept going down that the divergence would get removed. So you just don't buy a divergence because it exists. There has to be a trigger, a mechanism for which you buy. The best way to buy a divergence when you see it in place is to wait for the first gap up. It can be 2-cent gap up. It can be a 20-cent gap up. It could be a $1 gap up, depending on the stock. And as long as that holds by the end of the day, and if you even want to take a chance early on in the day, what you then do is you buy a stock and you close your eyes and you watch it go higher. Now, it's really very little risk reward. Why? Because when you get the gap up, if you buy here, you immediately sell if it falls below this closing low. It's as simple as that. It allows you, though, to make tremendous gains in the stock market, and I mean they can be tremendous gains. The hardest thing to do is to buy weakness. Am I right or wrong? Come on, folks, everybody shake your head. The hardest thing to do in the stock market, and the greatest gains I've ever made for my people, have come through long-term divergences. But you can also do it again on a 60-minute chart, a 1-minute chart, a 1-month chart. It does not matter. You see the divergence in place, but you don't buy it because it could continue down. When you get your gap up, or an engulfing stick, and if I run into that, I will show you that along the way as well. But you want to mostly see a gap up, and you're good to go. You're good to go. Let me show you some more. Let's see if I can, don't get stuck on me here. There we go. Take a look at this chart. I'm going to make this hard for you to see. See if you can find me a divergence. Remember, it's the most recent lows only to themselves. Take a look at this bottom and then this bottom. Notice how the MACD is staying higher. When you get either your first gap or engulfing stick, means a stick that takes out the prior day entirely, or a gap, you're good to go. And these can be long-term holds. When you have divergences and you have the buy signal on the divergence, it is, in my opinion, the single best way to make money in the stock market. But you have to be unafraid to identify them. You have to be unafraid. You have to take the emotion out of the game and say, I'm now not afraid. I see the divergence. Here you see a move down. Your MACD's here. You come up. You make an equal or slightly lower low. Look how much higher the MACD is. And when you get your first gap, boom, no engulfer here, but you get your first gap up and go. And let's face it, if you saw a stock at 35 go straight down to 15, double test 15, it's very hard to buy. If you're going to be honest with yourself, it's extremely hard to buy. But then you get this. And how do you know when to sell? When you get overbought. And we will talk about that in a minute. We're not there yet. It can be an equal or a lower low. The most next to itself right here, the next equal didn't make a lower or equal low here. It took until here. And when you have that equal or lower low and then you get your gap up, you're good to go. These work tremendously well on short-term time frames. For those of you who love to play 1 minute, 5 minute, 10-minute, 2-minute charts, whatever the heck it is you're playing, God bless you if you do it. You can use these with great frequency. They show up all the time on your shorter-term time frame charts, especially the 1, 5, 10, 15-minute charts. They show up all the time. But they also show up all the time on the 60-minute charts, which I love to use. And I consider that as well a short-term chart. You can do tremendously well with divergences, unbelievably well with divergences. Then there's something called a negative divergence. And that's when it's very difficult to sell or short. A stock could be going up over time, and suddenly you see a negative divergence, but the stock's been doing so well, you just can't get yourself to sell it. That's the emotion of the game taking over. I'm trying to use more long-term charts to show you the power of these things, how far they can go. So here you see a high, and you eventually make a new equal or new high, and you finally get a divergence, a strong one up here. Now this wasn't a gap down, but notice that this candlestick completely engulfed this one, and then some. There's your sell signal, and look at her go. These are for those who want to play long term. Again, if this kind of thing showed up on a 1-minute chart, a 2-minute chart, a 5-minute chart, and they do all the time, once you get either your engulfing stick or a gap down, you're good to go. And these MACD breaks can be very subtle. For instance, here's a move up off the bottom. You come down, you make a slightly higher high, but notice the MACD is lower. Not tremendously, but lower. And when you get your first gap down from this candle to this candle, there's your sell signal, and eventually it just gives it up. And these are tremendous gains with a $30 stock down into the 28 level. So you can do really, really, really well with this if you would take the time to look at it. That's all it takes, a little bit of time to study these, and especially, and again, I play it on those short-term time frame charts. They are wonderful. Here's a classic example of basically an equal high, maybe slightly higher. Move up, down, up. Look how much lower the MACD is on this second move up. No impulse. Here's your gap down, boom, and you're off to the races. Here's a stock that went from about 62 all the way to 55 before it got too oversold. And again, we'll go over that in a little bit. That's something you will need to learn to look at and to watch, because knowing and understanding where the stock should be sold once a divergence is in place and it starts to work is also important. There are many, many critically important aspects of this game that you need to learn about, and that's reality for all things. So, again, understanding and recognizing divergences are a very, very powerful tool. Very powerful. And they can be super subtle. Here's one, slightly higher high, slightly lower MACD, you get a move down, you get oversold. You come back up, and even lower MACD, down again. So again, it's all about trusting the divergences, and when you get your gap downs or your engulfing stick, here's an engulfer, you take out the prior day completely. Here off this gap down, you get quite a move here, 10%. You often get between 5 and 15%, sometimes more on these divergences, on the longer term time frames. On the shorter term time frame charts, obviously they're going to be lower amounts, but they can be beautiful winners. They could be beautiful plays for you, just understanding the divergence. So you're comparing the most recent highs and lows to themselves, looking for that lower positive line, your 12-day, your thick line, your thick line here, your black line here, and understanding that really is a wonderful way to make some money. Now, understanding overbought and oversold, and this is critical. When you're using RSI, which is Relative Strength Index, it's nothing more than a momentum indicator. It's all it is. You basically, it defaults to 14. It's a 70-30 line. You could just make note of that. It's 70-30. When you get to 30 RSI, you're oversold. So are you going to short 30 RSI? Can it work? Yeah. How often does it work? Almost never. Here's a time where it stayed 70-70. It went a little more. You can get above 70. It can stay overbought. But most of the time it's 70 and it's 70, you're going to struggle. Most of the time when you hit above 70, it's going to struggle. Momentum goes away. But when you hit 30, you find a bounce. When you hit 30, you find a bounce. This is again where emotion comes into play, where it would be best if you could learn to put it away. Because you're saying, oh, this stock is terrible. But if you look at the momentum indicator, are we at 30 RSI? Are we at 70? Anything in between is completely irrelevant. It's when you get to 70, you can get a little above. When you get to 30, you can go below. But when you're at 30 RSI, shorting a stock makes very little sense. This is where emotion comes in. Oh, the stock is terrible. I'm going to keep. No, you don't want to short. And if you've been short, when you get to 30 RSI, you want to strongly consider getting out of the short. It doesn't mean it's a buy signal. It just means in the very short term, you've gone probably about as far to the downside as you're going to go. No different on 70 RSI. If you're long a stock and you hit 70 RSI, you have to start thinking to yourself, I've probably used up most, if not all, the energy that's available to me for this stock to the upside. You want to look, look, 70, you get slightly above, it comes down a little bit. You get slightly above, it comes down hard. You get to 70 here, it stays a little bit, it comes down a bit, it struggles, you try again, but a long black candle doesn't work. You start losing your momentum. A long black candle means you open here, but close down here. Once you start hitting this 70 stuff, it's no good. By the way, you can also see, here's a move up, down and up, lower MACD, you get a gap down eventually and down you go. So here's a negative divergence playing into the near overbought conditions. This is where you learn to put the package together, where you put the package together that tells you what are the odds. And this is what I mean, going back to emotion. I'll skip that. I'll just make this a little easier for you here so we can do other. I don't have too much time today, so I'll rush through things a little bit. This is where you have to put all the emotion aside. And this is why I believe in the end the only way anyone can ever truly succeed in this game is if you're as emotionless as possible. It's impossible to be completely emotionless in this game. Impossible. I admit that. I understand that. I get it. I get it. You really can't be emotionless in this game. There has to be some emotion to the game. But what you're trying to do is let indicators, divergences, different momentum indicators, take away as much of those emotions as humanly possible. If you can't do it, it's not going to work. You're going to play with emotion. You're going to struggle. The game is going to become more difficult. That's not what we're looking to do here. We're looking to make your life as easy as humanly possible. Stochastics is another momentum indicator. This doesn't say 30-20, this 30-70, this now shows 80-20. I don't use 80-20. Write it down. You use 90-10. 90-10. When stochastics get to 90, stocks tend to struggle. When they get to 90, stocks tend to struggle. When they get to 10, stocks tend to do better. When they get to 10, stocks tend to do better. When they get to 10, stocks do better. Again, better. Why is it so important, again, to understand all of this? Because, again, this is emotion, right? When the stochastics are 10, near 10, it could be 15, it could be 5, they can go to 0, it could be 20. But when you start getting near 10, most of the selling momentum has been used up. However, stocks look terrible when you get stochastics at 10 because it means they've been selling. So again, this is a way to take the momentum of a stock, turn it around in your favor when emotion is saying no dice. Emotion is saying right here, you wouldn't touch this. In fact, emotion is saying, should I short it? That's what emotion is telling you. Should I short this? Well, the reality is when stochastics are 10, now what will often happen, stochastics lead over RSI. So when stochastics are getting towards 10, RSI is going to be getting towards 30. So you're going to have multiple things telling you, multiple momentum indicators telling you we're too oversold. Conversely, when stochastics are in the 90s, you're going to see RSIs get up towards 70. And when RSIs are up towards 70 and stochastics are up towards 90, can they both go a little higher? Yes. But at that point in time, your reward on the long side is waning. It starts to diminish rapidly. And if it's on long-term time frame charts, it could take weeks or months to play out, usually weeks. If you're on very short-term time frame charts, it could take hours to work off. 60-minute chart could be worked off in a couple of hours, a day, day and a half at the most. Daily charts can take much longer. Can take weeks what takes 60-minute charts an hour or a couple hours or a day to do. It's very important for everyone to learn how to use these indicators. Even when a stock has great momentum, and I want to show you how overbought, here's in the 90s, you start to lose your momentum. It comes back up, you start to lose your momentum. Then it makes then you get down to the bottom here at 10, you start to gain momentum. Here at the top, you start to lose it. And again, only when it gets to 10 is it relevant, so you're probably going to lose it here. But notice when it gets up near 90 here, you start to lose your momentum. Even for stocks that are in tremendous uptrends, will show you in the short term when things are far more risky than they previously were. It's incredibly relevant to recognize stochastics and RSI working together to help you to know when it's best to start losing that emotion that's telling you down here at 10, you know what, this stock's in a long, boy, this is going down. Wait a minute, 10 stochastic, oof, you get up too high, it starts to become more difficult. You get back down, it's not quite at 10, but at 20, you start more risk, goes back up, gets to 90, comes back down, goes back up to 90, starts to come back down, gets to 10, starts to go back up. Here at 20 or 18, starts to go back up. Here at 90, it starts to struggle a little bit more. This is a constant theme. It doesn't matter if you're looking at an individual stock. It doesn't matter if you're looking at an index. It doesn't matter if you're looking at bonds, anything that has a graph, anything that tells you anything in terms of momentum indicators, and everything has them, can guide you to where you start taking out the emotion of the game. And the reason I keep bringing up that word is because, folks, in the end, it really is all about emotion. Excuse me. If you're letting that rule to roost, you are in very, very deep trouble. And the odds of you succeeding as a trader are almost non-existent. Almost non-existent. Nothing is 100%. And some traders can do well, whatever, if you're emotional. But I have to tell you, most of you know, when you get emotional, does it work? Don't you find yourself slamming your hand down on the table, using stochastics in conjunction with RSI, stochastics 1090 rule, in conjunction with RSI's 3070 rule, help you understand when the risk reward is better in a certain direction, understanding how to use negative and positive divergences. By the way, my webinar, which you'll get for free if you take a trial, 19 bucks, whatever, I don't know what it is, dirt cheap, and you get a free trial, 3-week trial. This is a 6-hour course. It basically covers everything, but I'm just explaining it to you now. 5-hour course, 6-hour course, whatever this is. Very long. It's been a while. Taught it forever. The reality is this helps you understand the market from a perspective that will make your life easier. Now, there's one other way to take emotion out of the game. Forgetting stochastics, forgetting RSIs, forgetting positive divergences, forgetting negative divergences. I've worked with people who've learned to use what I'm about to show you here. And I see we only have a few minutes left, so I'm going to do the best I can over the next few minutes to show you as much as I can. Crossovers. MACD, forget about the 9. This is your histogram here. We're only interested in 2 lines, your thick line, your thin line. Your thick line is your 12. That's your positive. No matter what service you use, I use stock charts. You could use anyone. They will have 2 different lines. One will be thicker than the other. Some are different colors, or red and orange, or black and blue. Whatever it is, it doesn't matter. You have your thick line, your 12-day moving average, your thin line, your 26. Now, this is really important, so pay attention. This is another way you can trade if you want to try to simplify your life, okay? It's another way you can trade. When the top line, your positive line, your thick line, I'm going to call it thick and positive, when your thick positive line is over your thin negative line, thick over thin, positive over negative, thin is negative, thick is positive, stocks trend higher. Not every day. I use the word trend. Is that understood? Trend higher. When you have a crossover, MACD crossover the other way, when the thin is on top, when your thin negative line is on top, this is all day long, folks, in any time frame chart. When your thin is over your thick, that's negative. The trend is lower. Once the thick crosses back up over the thin, positive over the negative, the trend is higher. When the thick goes back below the thin, when your negative is over the positive, you trend lower. If they're meeting, there's no trend. Once it crosses up, thick over thin, positive over negative, bingo, trend higher. Starts to cross down, trend lower. This is not complicated. This is not nuclear science, nuclear physics, or anything else all that complicated. The reality is you can use crossovers as a very wonderful way to play the stock market if you want to play trends. If trends are something you're interested in, it's something you can do without a problem. Just do it. There it is again. Thick underneath. The thin is on top, you trend lower. When you get your cross, you trend higher, and notice again it's holding above. And as long as this held above, the thick over the thin, you trended higher. When the thin was on top, you trended lower. When the thick on top, you trended up. You get the idea. Boom, boom. You see it on every time. You can do this. This is not complicated. This is not difficult. There are many people who don't like trading all the time but want to be in on a trend. This works on a 1-minute chart. This works on a 5-minute chart. This works on a monthly chart, on a daily chart, on a 60-minute chart. It doesn't matter. It just doesn't matter. When your thick line is on top, the trend, you have your down days, tons of them, but the trend is higher. When it's not, I won't waste your time because we don't have too much time for this now. You see here, boom, you start to move up, your trend is higher. When you cross down, your trend is lower. When you cross up, your trend is higher, and on and on and on and on and on. It's not complicated. It's really not. There are lots of people who are too emotional in the stock market. That's a lot of people. And one of the really great ways to remove the emotion of the stock market is to just play your MACD crossovers. Forget your negative divergences. Forget your positive divergences. Cool, you can forget about them all. It's all right. Forget all of them. Play your MACD crossovers. You can do that. It's okay. And do well. And if you want to be a short-term trader, you could do that on a 60-minute chart, and that's okay to do too. This is the toughest game in the world. I have only a few minutes left, so I'll just talk about this now. I don't have time to do anything else. Thank you for being here, everybody. I really do appreciate the fact that you all came in here today and showed up. I really, really do appreciate that. You have to understand that this is the toughest game in the world. Anyone who tells you it's not is lying to you. This is, without a doubt, the toughest beast on the planet. Very few people do it for a living, and very few less than that ever succeed. You have to try to learn little tricks and trades of the game that can make your life easier, and the only way you can do that is by taking the emotion out of the game. If you're emotional, you have, I believe, personally, I believe you have virtually no chance of success. If you play by every wiggle in the market, by every little up and down, by every little 50-cent move on a $100 stock or 5-cent move on a $30 stock, you can't succeed. But if you can have indicators that you trust and you know are true and over time will play out more than not, nothing is 100% in this game. Nothing, nothing, nothing. But if you learn to trust your indicators, stochastics and RSIs, if you learn to trust your MACD crossovers or your divergences, and there's a lot more to this game. I don't have time. I got a million other things on this webinar. The moving average test, volume, everything. But if you learn to trust stuff, just even the little things I showed you here, you can have a better experience with the stock market, a better experience. Nothing is perfect in this game. It's very hard. It's brutal. It's a difficult game. It's a beast. But by taking emotion out, you certainly improve your odds pretty dramatically. You can do well. You can have more positive experiences than negative experiences. You can. But you need to be calm to do it, and you need to trust these things. Over time, you will learn to trust. Can stochastics get over 90, 100's the max? Yes. But basically, the closer you get to 70 stochastic, the more risk to the long side. Same thing on 10 on the other side. Same with RSI at 30/70. Same with your crossovers. So be patient. It's a game of patience. You're in a big gambling casino. You're in a huge, massive gambling casino. And the temptation is off the charts. So you need to be better than that. And some of the tricks I've showed you today, they work. And again, the beauty of them is you could be a day trader, a minute trader, or you could be a long-term trader for weeks and months at a time. They work. They work. They work. Don't be afraid to let things work for you. Don't have your head in the game that something has to be a certain way. Nothing has to be a certain way. There is no such animal. Do not let your emotions and what you think should be ever tell you how to play this game. Let other indicators, you're all technical people, teach you and guide you and direct you. That won't be your experience. I guess, Reed, I see it is 4:45 here. So I guess I would ask if there's any questions or anything I need to do from here.
No, I'll actually take it over from you. I believe
I'm
we
not hearing
have.
anything, so I gather my
Sorry.
time has expired. I
Okay.
thank you all. Swing Trade Online is my service. Come on in for a free trial, swingtradeonline.com. And I hope this was somewhat entertaining to you and taught you a few things that you can use down the road for yourselves as traders over time. So I thank you for your time, and I appreciate your being around. All right, everybody. Peace out and enjoy your lives.